Welcome to the Market Enthusiast podcast, where Good Life's Noah Brooks, Chief Market Strategist, and Chris Needs, Senior Research Analyst, break down today's topics, covering their impact on the economy and personal finance in a fun, easy-to-understand way for investors of all levels.
Hey, welcome back to another installment of the Market Enthusiast. I'm Noah Brooks, and obviously this is Chris Needs.
Hello, hello.
All right, here we are. Beginning of August, we are super close. I mean, we're going to end the day at all-time highs today, right?
Another one.
It's
been a lot of that this year. We had a little gap, I think, going back to early June, but now we're right back and having a few in a row. It's easy when you're at an all-time high to get another all-time high.
Is it?
It is. Just
that momentum just
you could
keeps
be
going,
1 cent positive.
Keeps chugging away.
Yeah.
Well, we were down about 5% in early June, and people were worried, and maybe another 3% in the beginning of July, and then it's just been off to the races.
It has been. Yeah. Hey, before we get into that, speaking of all-time highs,
what's that?
Just worth mentioning, we've had a little bit of a milestone here. We'll say we don't just come on here and talk and everything.
My hair
like
didn't
that.
grow back.
It didn't grow back. But we manage money here too. We trade, we run models, we run portfolios, and we passed $3 billion in assets under management.
Yeah.
That's a big checkpoint. How's it feel? Did you see this when you started this program 10, 12 years ago that it would get to $3 billion?
When we started Portfolio Solutions, you know, the founders asked me to come up with something that we could help advisors and investors run models essentially for. And we started with almost nothing. It was like $30 million. And it just over the years, as advisors joined Good Life and more investors joined Good Life, it just grew and grew and grew. It doesn't hurt that the last 13 years in the stock market has been pretty good as well. But I mean, we obviously, went from, a few hundred accounts in our Portfolio Solutions models to, 12, 14,000. And the advisor count grew from 3, the 2 founders and myself, to 70 advisors are using the models in our trading service. So it's been phenomenal, and I'm just we're super fortunate to have been able to be in the middle of it. And we put a lot of work into it. Everybody here, and you too. I mean, I know you weren't there with me 13 years ago, but you've been a solid ride or die over the last 5 or so. So, and everybody else here at Good Life, the investment team and the traders and things like that. It's been phenomenal.
Really proud of this moment. Ever since it got in our crosshairs, it's been like, all right, when are we going to get it? When are we going to tick that number?
Yeah, $3 billion. It's a lot of money. I mean, the firm runs or has a lot more than that, but in terms of what we're directly managing,
we have our hands in the pie. We are literally trading those accounts. So it's
I love putting
fun
my
to
hand
see.
in the pie.
Yeah.
But it doesn't hurt that we're at all-time highs. So I did a little bit of just fun with numbers earlier. And do you know what the 3-year return on the S&P 500 is?
It is probably 3-year number, maybe 80, 90%.
It's 75%.
Okay.
Do you know what the 5-year number on the S&P 500 is?
So we have 2022 in there. We'll call it 80%. Still.
It is 75%. It is the exact same return on the 3-year number versus the 5-year number. And that means, there's a lot of different ways to slice this up and to think about it. But realistically, and if you just said, hey, we have a 75% return, you'd be like, oh, that's amazing. And I don't mean us, I mean the stock market. But you had a 2 years in there that your return was negative.
Yeah.
Right. In order to have a 5-year return and a 3-year return be the exact same thing, you had to take that ride down. And it's one of these things that I always go back to with investors and advisors is like the cost of admission in that 75% return is a down 20% year in 2022. Mm-hmm. It has to happen. If it was only up, there would be no risk and everybody would just be doing it. There has to be a downside in order for those long-term returns to happen. So, stay invested. I say that we're at all-time highs. We could have had this conversation at any point really over the last 10 years and just said, oh, we're at all-time highs, and people get a little bit, caution, or it seems like a cautionary tale not to invest at all-time highs. But the fact of the matter is we just keep making more all-time highs.
Yeah. Everybody in the industry knows all those charts. I'm sure many retail clients also have seen those charts where it's the reasons to sell. But, if you check, like you said, since the great financial crisis, 2010 on, there's lots of reasons on that chart, but I'll tell you what the stock market still did.
Yeah.
In the end, the indexes still went up.
Yeah, absolutely. We talk to advisors and investors almost every day, and we constantly are giving reasons why we are not in a, let's say, valuation bubble, and people should stay invested. But it's really easy when you're listening to the financial news, or God forbid, you're listening to the regular, nightly news, and it's just one negative thing after another. And at the very end, they put a nice little sweetener in there for you. Like, oh, that's so cute. But, it's just,
Oswald, that ends okay.
Yeah, it's just negative. And so it's really easy for investors to get burnt out on it and just say, I want to, take it off the table. But I encourage people not to do that and try to be opportunistic. This year when we had started the Iran, what do we call
Kinetic action.
Kinetic action. Yeah, the kinetic action in Iran. If, from the bottom there, which was in mid-March to where we are today, it's up 23%. So for the year, the S&P 500 is up 13%. Mid caps up about 18, small caps up over 23%. Emerging markets are up 24. I mean, it's just, it's been a tremendous year. Not everything is moving in that same, they're not moving parallel with those returns. I mean, large growth as a asset class is only up about 5. Large value, we're trending upwards of 24%. I mean, the earnings have been phenomenal across the board in the S&P 500.
Q2 S&P 500 earnings 47 so far on pace, 47% year over year. That's phenomenal. Why are people so bearish or so scared in the stock market right now? That's phenomenal. That's, numbers we don't see outside of post-recession or post-crash levels.
Yeah.
Last time was, I think it was Q2 of 2021 or maybe Q1 of, Q2 of 2021.
Yeah, after the COVID rebound.
Yeah. Obviously that is a quote unquote post-recessionary. We literally shut the country, the whole world down. So that makes sense. But in the middle of a bull market like we are now, super impressive. And then obviously, on to piggyback on that, you have, profit margins at record highs, highest they've ever been, 16.7% on the S&P 500. Rare air.
Yeah. The first thing that I think of when I hear that 47% is, okay, we're not I don't think we're in a valuation bubble. Are we in an earnings bubble?
That's definitely something you can debate, certainly. And the guidance keeps going up. I was talking to you about a chart that basically shows, for all those concerned about a bubble, the .com bubble versus right now the AI run. I'm not calling it a bubble because it's not a bubble.
Oh,
but
of course it's not.
You see the forward price to earnings multiples going up through the whole .com run, going up farther and farther higher, obviously more expensive when the PE goes up. Right now, because of how amazing these earnings are, the forward P's are actually going downwards.
Yeah.
So markedly different than back then.
Earnings continue to get better and better and better. And obviously we've talked about the Mag 7 turning into the Lag 7. We've talked about AI. AI is kind of trending from, let's say, a stock market thing to more of an economic thing. Estimates are saying that about 2% of GDP are going to be through AI data centers. And when you think about some of those jobs out there and how it trickles through the rest of the economy, I mean, in terms of GDP, electricity consumption, the chips, the cooling, the land, transmission infrastructure in and out of those places, even some of the debt financing goes into the GDP. And then obviously skilled workers that you need to run these things, even though, we've talked about it here, you don't
per dollar. There's not many workers in a data center, but there is still highly specialized people.
The tertiary benefits and jobs around the data center really do add up after a while. So 2% of GDP. I mean, if I'm doing my math correct, I may not be, but residential housing is only 5% of GDP, approximately. I mean, for an entirely new, I don't want to say phenomenon, but an entirely new industry that really wasn't here 10 years ago to be now worth 2% of gross domestic product, that's a pretty big move. And obviously that's why the market has gone up, or these companies have gone up, the data centers and the hyperscalers and all that stuff, and all of the connected investments around them. So, I don't know what 10 years from now looks like. I don't even know what 2 years from now looks like. I think we can all try to figure it out. But the reality is that this stuff isn't going to go away, and continued investment in artificial intelligence is really going to be driving efficiencies across the board at companies, and driving productivity in the end, for the aggregate results. There's no way that you can avoid it. I've had people ask me, well, can we invest with, let's say, low tech exposure? Now, you mentioned that the other day, that earnings in Europe has very low tech exposure compared to, let's say, emerging markets and to us here in the United States. And so you can make those portfolios work, but you just miss the earnings growth, right? I mean,
you can be in low vol that will have very low tech exposure. They have portfolios and factor tracking securities out there that you can do. But I feel like it's especially for what we do, where, of course, being professionals, we are gauged against the benchmark. It'd be tough. It's like I was saying, years ago, is like, you have to have exposure to NVIDIA, because if you don't, and it goes to the moon as one of the top components, you look like a dummy. So it's just one of those things where it's like
looking
you
like
can
dummies.
Right. You can have measured exposure, certainly, but trying to eliminate it altogether, that's also in its own way a very bold bet.
Yeah.
Because you think that's essentially betting that we're going to be less technologically advanced in the future than we are now, which seems like a very easy answer to most people on Earth. Are we going to have more or less technology in 2050?
Less? Nope, not happening. All right, so moving on, a few other things. We are still facing higher energy prices. That has come through in some of the reporting. CPI, Consumer Price Index, was out a few days ago. We had the year over year up 3.4%. When you strip out food and energy and get to the core, it's up 2.5%. So inflation is
that's not too bad. That was a good number. The market kind of liked that.
Yeah, it's not too bad. But more importantly, I think the thing that really came out of this is that the Federal Reserve was almost feeling like it was backed into a corner here. And, then we had some weak job numbers, right? Negative 23,000. And we can have that conversation as well.
GDP estimates a little light as well. There's some things letting air out on the Fed, letting them out of that corner.
Yeah, they're not boxed in.
And, we sort of joked about how it seems like the market tests new Fed chairman. So his first two meetings, Warsh's, did not go that well. We always joke about the sweet voice, calming voice of Jay Powell, and it doesn't seem like the market's giving him the benefit of the doubt yet, because every time he talks, these first two meetings, it's gone down. Now, this data we've gotten over the last 2 weeks is beneficial for the lowering yields, lowering pressure on them. But we need another set of data points, because there is no Fed meeting in August. The next Fed meeting is in September after we get another set. So this is a one of two data set we're dealing with right now.
Well, you mentioned lowering yields, though. What I was looking at earlier was some of the highest mortgage rates.
I need someone to buy my house, Noah. We don't need this negativity.
It's 6.7. The average 30 now is up to 6.7. Now, it had been closer to 7. In the last few years, but we were down almost, I think maybe one day it started with a 5 or something like that, but 6.7 now.
I got quoted in December at 5.8.
Yeah.
And now I think it got up to like 6.75 or higher.
It says the average
2 weeks ago,
30 years is 6.7. Yeah. That's not great.
Yeah.
And then I think yesterday's or today's bond market sales on the 10-year were 4.67%, some of the highest that we've seen in over a decade. Not just the yield, but the government selling those bonds. So it feels like the market
40 trillion is right around the corner. Like, we're
I think we hit
talking
it
in
today.
a month. Oh, we did?
I think there was a number today.
There you go.
40 trillion in national debt.
Yeah. We were last stat I saw, we were at like 39.8, and that was like a week or two ago.
It's just cranking away. It's
Yeah.
just right. Those numbers. I mean, we're at was it I don't want to misstate it. Was it 3 billion a day or 3 billion a week in interest?
I'm not sure.
It was some crazy number.
Trying to do the math on the fly in my head, but I don't want to.
don't want to do that. Don't do that one. But I mean, things could be worse, right? The economy seems like it's on cruise control. Everything is chugging along. Unemployment is reasonable. I mean, it keeps coming down, and we can debate, the labor force participation rate, things like that. Energy prices, I'm going to say, are relatively stable. Right. So obviously they're up year over year. But since the Iran war started, they were as high as over, I think, 120 one day. We're around 86 today. When we were in here 2 weeks ago, they were at 86 or 87. Relatively stable. And the main driver of all this cruise control is that the consumer continues to spend. During World War II, Britain had the keep calm and carry on. We are now, and I'm not saying we're at war, even though we are at war with Iran, but we're kind of in this, keep calm and continue shopping phase of everything. It's just, people are spending what they have. The savings rate is not particularly well.
Retail therapy is a real thing.
Oh,
when I'm feeling bad, buying something surely helps.
My retail therapy is vacation, right? Buying flights somewhere. That's my retail therapy. You can tell because I look like a slob most of the time. I don't need to go out and buy clothes, but I should. I probably should. My wife would probably appreciate if I bought some clothes here or there. But retail therapy is great. And the American consumer is playing retail therapy every day. If we saw an increase in prices and crude prices, to 100 or 110, I think that would sap some of the spending out of the market. Mm-hmm. I mean, there's a tranche of people out there that don't care whether gas is $4, $5, $7. It doesn't make any difference. But then there's, I know your electric car. I get it. And
I want it to go down so yields can sort of come down. They are kind of tied. And just a quick call out, very unhappy anniversary right now here in August. 6 years in a drawdown for the U.S. bond ag. 6 years. That's 4.5 times longer than the next closest, which was back in Volcker's campaign back in 80 to 81, which was 16 months.
Yeah. The traditional bond market, the ag itself is just not been tremendous. Even clipping that coupon, clipping those interest payments has not really resulted in
that's been your return essentially.
Yeah, it has been tough. I mean, we had rates come down. I think in 1981, the 10-year yield was like 15.4%. Anybody out there listening that bought a house in the early 80s knows what their rates were, and they laugh at 6.7%. Yeah. Someone told me they had like a 17% mortgage or something. But essentially, yields were falling, with some ebb and flows over the years. In 1994, they bounced up. But overall, for the last 40 years, up until 2022, yields were just falling. Mm-hmm. And that doesn't seem to be the case. And we can debate whether they're going to raise or not raise. But overall, yields were falling for 40 years. And now they're basically went up, and they've stayed elevated significantly higher than they were, 5 years ago. That has been hard for fixed income investors. And it really shows why, equity markets have been leading those returns over the last, not only 6 years, but over the decade and over the last 20 years. I think the total return or annualized return of the S&P 500 is now over 11% for the last 20 years, where the fixed income benchmark that we follow is really about 3.25% over the last 20 years. And those are big differences.
Yeah,
dramatic differences. But it goes back to those earnings.
Yep.
Right. I mean, here we are. You're talking about a 40% year over year earnings growth. You're not going to get any earnings growth in the fixed income market.
No.
It's basically not. You're betting on rates to go down.
If we're in a higher rate regime going forward, based on where debt levels are at, if we're talking about treasuries, there's going to be some academic research coming on. There already is, but more academic research and more attention to, is the old like static risk portfolio matched with a risk-free treasury portfolio? Is that really how we should proceed forward in allocating stuff? Obviously, what we do is a little more technical than that, but in essence, you have like the market portfolio and you have the bond portfolio, and you match up your risk with that level.
Are you trying to imply that
traditional finance is outdated?
Modern monetary theory has some credence to it?
I think there's a little bit of room to look at in a rising rate regime.
Yeah, I mean, a 60-40 portfolio when rates going up is going to be significantly different return than a 60-40 portfolio when rates are trending down.
Yeah, you just 3 times levered.
No, let's not do that. Let's not do that. But all in all, markets are having a fabulous year. We have a we don't put out a specific price level to our advisors or investors, but we said, up 10 to 15%. We're there now. We could certainly get higher. It could get lower. This whole situation in Iran,
we're not in the business of changing our predictions as quickly as some of these other analysts out there. You see different price targets thrown out like every month, it seems like, and it's like, what's the point then?
No, you start with one in the beginning of the year. This is my opinion,
and you can change how you're talking about it and your expectations, but you can't just keep changing your price target. That's cheating.
Well, we do not cheat around here, right? We don't cheat. But the one thing that I keep coming back to is this Iran thing. And obviously we have midterms coming up in, 85 days, 84 days, something like that. There was a note out from Fordham Global Insight. Tina Fordham put this piece out talking about the possibility of Iran and Oman coming up with a deal. Trump would complain about it loudly. The rest of the Middle East would probably just kind of comply quietly. And she made reference to the salami approach, which I'm not familiar with. You know what the salami approach is?
Chipping away at something
slowly. Chipping away, right? Slicing a little bit off the salami at a time. And that's what it seems like Iran is doing. They just keep moving forward a little bit and, getting a little bit of advantage, knowing that Trump doesn't really want to escalate into midterms. Now, I don't think they can go in and they can't cut off a giant piece of the salami, because that would really force the administration's hand, and they go in whether that's capturing the island, Karg Island, or something like that. I don't think they can do that, but I think the calculation here is that he doesn't want to ramp things up in the next 80 days, and drive oil prices even higher. And the data that is shared with me says that there's still a fair amount of oil coming out of the Strait of Hormuz. I don't know any specifics on who's getting it out, but in terms of the number of barrels a day, it's not, it's not closed.
It's not zero.
Yeah, it's definitely not zero. It's far from zero.
We have inflicted a lot of economic pain. Inflation is going up pretty quickly in Iran. I thought it was real rich. Their one demand of, you pay us war reparations. I'm like, I don't think you understand how war works. Like, this isn't World War I and World War II where everybody's in agreement. It was Germany. This is not like that at all. So I just think it's real rich. And then I think Trump came back and he was like, well, then we're going to charge you reparations for the last 50 years of terrorist proxy activity. It was I just had a good little chuckle on that.
So you mentioned proxy activity, terrorism. Have you watched Pan Am 103?
I have not. No.
Have you seen it?
I mean, I know about Pan Am, everything that happened.
Lockerbie, Scotland. So it's actually not brand new, but I think it just came on one of the streamers, Apple or it doesn't
Netflix.
matter.
Ackman's new purchase.
Oh, he did purchase some on Netflix, right?
Oh, yeah.
Okay, hold on for that thought. So the reason I bring it up is because you mentioned terrorist proxies. In the end, it was found that the Libyan government was behind the bombing, not that Gaddafi had put the bomb on the plane or something, but that, their Secret Service
funneled money and facilitated in a way.
Yeah, absolutely. The people that actually delivered the bomb onto the plane were part of and being funded by the security outfit in Libya. And I think in 2001, they wound up admitting to it, and Libya paid some extraordinary number to the families of the bombing. It's an interesting show to watch. It's a limited series. I think it's 5 or 6 series. I definitely would recommend it to people out there. But we live here in the United States. We live, generally speaking, far away from those types of things. I mean, we've had obviously 9/11 happen, and seems like there are mass shootings pretty frequently, but we're removed. We're not being bombed by Iran, and so we can kind of go about our business, go about our work. And the stock market has not really cared about it. They care about oil prices, but I think we could go in and we could continue to bomb them, and the stock market isn't going to move.
Relatively sanguine, as Jim Cramer would say.
Yeah,
sanguine.
Well, it's about earnings.
Yeah,
right. I mean, that's really what it is about.
And you say it all the time. Will this impact earnings here? And right now, obviously, it looks like the market's voting no. This won't really come over to us and impact our business.
I tell investors all the time, the market is not a moral barometer. It's an earnings gauge, right? That's it. So no matter how you feel about what's going on in the world, good, bad, indifferent, the market, it just simply says, is this going to impact earnings or free cash flow in the future? Yes or no? Mm-hmm. And if it's no, it doesn't make a shit of difference. Not even a little bit. Not even a little bit. So yeah, but I mean, there's a lot of things that do impact us that the market doesn't care about. And then there's a lot of things that impact the market that we don't care about, right? Mm-hmm. That's why the inflationary tail that we're seeing seems to be a little bit cautionary, because at some point you question whether or not there is going to be a slowdown in consumer spending. Obviously, there has not been at the moment, but I'd love to see oil, less than 85, even 80, 75 would be great. Where we are, it doesn't have to go back down to where it was pre-Iran, but seeing it at 65 would be really nice. Mm-hmm. Give everybody a little bit more spending in their pocket, a little bit more money in their pocket, so they could spend on other things. Speaking of spending on other things, I grew up with a grandmother who watched QVC all the time. Do you know what QVC is?
I do.
Okay. Well, they were for the uninitiated out there. It's the home. It used to be the Home Shopping. Well, I think they bought the Home Shopping. It was the Quality, Value, and Convenience. I think they named it originally in the mid 80s.
It's a hoarder's dream.
A hoarder's dream. You could just call up online and order it. Well, now today, I mean, that's a thing of the past. QVC went bankrupt. They just emerged from bankruptcy. I don't think we're ever going to get more live television stuff, but a lot of the spending has gone to TikTok and YouTube. And
I don't even see as seen on TV ads anymore.
Well,
they used to be great.
They don't have those on the streamers, right?
Oh, true.
No,
true.
But when you're on Prime and they go into a commercial for something, there's a little buy it now.
Yeah. Connected right to your credit card.
Right there. Just hit the button. Hit the button. I mean, your kids could be on there just tapping away.
We've deleted many purchases on Amazon because they, on their tablets, the Fire tablets and stuff, these kids can click on anything.
Oh, really?
No one finds out the passbeds, and he just starts clicking through.
How does he find out the passwords, Chris?
So he watches me put it in right in front of him. He even found out how to change it one time, so I couldn't get into it.
What?
He just changed it to all ones, and it's like 8 ones. I'm like, how would I ever guess that? Like,
okay. Well, speaking of things that kids do, there was a report this week that a 7-year-old and a 4-year-old stole their parents' car in Oakland, California, and were joyriding around. It didn't last too long. They crashed a few blocks away from the house, but they were flying. They're doing like 70 miles an hour on a 25-mile-an-hour road, 35-mile-an-hour road. Eventually crashed.
Cruising in my
really
6'4".
They really hurt somebody. I don't know if they got
Oh.
hurt, but all the airbags went off. They very much injured a woman. And I'm just thinking to myself, like, to be 7 years old and your 4-year-old brother and you're taking your parents' car for a joyride. Holy crap.
Kids grow up so fast these days.
I mean, it's what's worse, ordering food by accident on your phone or joyriding, right? Like,
yeah,
I don't know, man.
Love a little Grand Theft Auto before you reach the age of 10.
Holy cow! What do you do with those kids?
Nothing. Nothing's gonna happen to them.
Something should happen to the parents. I don't know. I don't know if that's a thing.
I don't know. I'm just gonna keep the keys away from Nolan.
But he already has your passwords, bro. What are you gonna do when he
That's
he
kind of
takes
the scary
your car?
thing. If you're making a great point, because I have like the phone key for my Tesla, and technically, if my phone is in the car or Nolan takes my phone and is watching a video, so I'm not like actively watching him, and he goes out to my car, he just zooms away. I won't even hear it. It'll be silent.
Did you ever take your parents' car for a joyride?
No.
No?
I was a good boy.
Get out of here.
I was a good boy.
Are you still a good boy? Okay. So you never joyrode. Well, hopefully.
Did you? You go for some cruises?
Heck yeah.
All right.
Heck yeah.
I thought it was cool just to back like the vehicles out of the way so I could shoot basketball. I'm like, yeah, I could drive this thing if I needed to.
My dad put me on his lap when I was like 9 and 10 years old and would let me steer. I couldn't reach the pedals, but yeah, anyway, it doesn't matter.
You were shifting?
No, I don't think so. We had a 1980.
Didn't grind the gearbox.
Yeah, we had a 1980 Toyota Tercel, a little 5-speed. I did learn how to drive stick on that car. Surprisingly, I don't think there's a lot of people out there that know how to drive stick anymore.
I agree. I don't think so.
Do you drive? Do you know how to drive stick?
have driven stick before. I know how to. I don't want to be starting on a hill. I don't want to like immediately have to get it in gear and start it on a hill.
So I was behind a big truck on the hill, behind a big truck on a hill the other day. And I probably got too close to the truck, not not paying attention. And he rolled backward when he started out. And it came really close to my car. And I just thought, wow, I have to remember to do that.
He was probably watching you. He's like, oh, I'm going to scare this guy.
He could be.
Squash this car.
Yeah, squash it. All right. So here we are about to wrap up. What else do you have for the good of the order here, Chris?
I mean, in our area outside of Philly, we know the big news, LeBron James coming to the Sixers along with Jaylen Brown. We have a star-studded cast. If we can, Joel Embiid looks healthy, looks light right now. That's good for his longevity this season, hopefully. Maybe we can get lucky and get 1 to 2 good years out of Bron. But how about the Lakers? The Lakers just got sold again, second time in 3 years. They were bought by Mark Walter from, was it Oppenheimer or Guggenheim? Guggenheim in 2023 for $10 billion. They just got sold again for $12.5 billion.
Any names we know?
Some good names, certainly. Former CEO, 2-time CEO of Disney, Bob Iger, and Josh Kushner. Yes, that Kushner family, very connected and such, and it was under interesting circumstances. So I have a conspiracy.
Okay, let's
you
hear
here
it.
for it?
Yeah,
Okay.
I want to hear it.
So there was pressure on Walter and Guggenheim being
pressure from
the FBI, and he was under a little bit of a liquidity crunch and sort of had a fire sale per se, and had to sell off this enormous asset. He made a good, cool $2.5 billion off of it. I don't know what the taxes look like in California on that, but I'm sure they're not good and they're very large.
Yeah.
But very interesting that such a connected person would be on the other side of that pressure. It's not so hard.
What are you implying?
There may have been some communication in my conspiratorial view that, hey, let's apply a little pressure. I really want that pretty asset there, the Lakers. And a little pressure, a few emails, or no emails, a few conversations to apply some pressure, and then boom, suddenly he's on the winning end of this bid.
Normally, I am not conspiratorial. Pretty much across the board, I'm not. But the interesting thing on this one is that it was an unsolicited bid
At the
I
perfect
understand.
time.
At the perfect time. Now, when you say unsolicited, like, you don't know what the relationship, I certainly don't know what the relationship with these people is.
The two of them were in talks with the NBA. So they were in the NBA circle of, the potential of an expansion team in the NBA, which there's been a lot of talk of. And they were sort of in the mix for that. But buying the most valuable team, I don't think, that was in the cards that anybody else was aware of.
So I'm just curious how Iger and Kushner got together.
Yeah,
That seems like an odd couple if I ever saw one, right?
Yeah, it does. I agree.
Do you know the relationship?
I do not. No. I mean, I know a little bit. Obviously, know Iger. Everybody knows Iger. So all I know about Kushner is, he's made some good investments. He has Thrive Capital, which is essentially, I guess, like maybe not a hedge fund, but maybe we'll say venture capital investment firm. And then he was a co-founder of Oscar Health, which is like a pretty notable telehealth type of future technology health company. But I don't know how the two of them got roped up. You would think they're on different sides. You never know politically.
You would think so. But
they came together for a great win on this deal.
I mean, if your, what does it make it? Is if your brother's father-in-law is the president, does that make you have to be loyal to one party or another?
No, I don't know anything about him politically, I should say. But Iger drew the ire of Mr. Donald Trump, President Donald Trump, when he was at Disney. So in this culture wars thing, so you would think he would, at the very least, not want to be with him, and it's such a big deal. That's just my opinion. Well,
we will see. They bid. It looks like it's going to happen. And we got Braun. Right?
We're the winners.
All right, everybody. Thank you so much for listening. We will see you next time on the Market Enthusiast.
The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.